As we embark on a new year, I wanted to share some of the biggest mistakes that I saw wannabe home buyers make as they went through the home buying process, especially with regard to utilizing financing. Okay, so here you go. First, we had a scenario where we had a buyer that was referred to us, and this buyer had already been pre-qualified by several lenders. And what was interesting is the majority of these lenders were online lenders. And so when we kind of get into the process, our process is a little bit different because it's not just push button, get a loan. With us, we want to set up that initial call. We're going to ask questions. We want to dive into what your goals are and be sure that we are putting together a strategy that can help you achieve those goals. So that insight is such a key element of the entire process. And it's just interesting when people have already kind of gone through this, push a button, get a loan, and then they're looking for more answers and they end up in a conversation with us. It's just so foreign to them. So one of the mistakes is realizing that not all lenders are created equal. This is a very emotional process. And especially if you're a first-time home buyer, you have a lot of questions. So use your gut. Choose a lender that can be patient with you, that can give you the guidance that you need to empower you to move through the process. The second mistake I've seen is that for the most part, people only know to shop interest rate. And while interest rate is a piece of the overall home loan process, it's not just about interest rate. It's about the interest rate. It's about the cost associated with the interest rate. And this happens all the time. Hey, I'm getting quoted 6.25%. Okay, well, we need to know your scenario, your story, to even be able to know if that rate is valid or not, because lenders can say anything until you're into the process, until they know what your credit score is, your debt to income ratio is, until they know what type of program you're doing, your down payment. All of these things impact interest rate. But the whole get pre-qualified in 3 minutes, hey, you get what you pay for kind of thing. Can a lender truly give that assessment and be confident in your ability to get your keys 15, 30, 45 days later? That's what you're looking for. In addition to that, it's just asking the right questions. So for that interest rate, what is the cost associated? Key. Because so many times I'll hear that interest rate and it sounds like a great rate, but then when we dig deeper and we're asking for the cost associated to get that rate, it can be astronomical. And it doesn't always make sense to throw money to buy down that interest rate. Sometimes it does, sometimes it doesn't. Sometimes there's a happy medium of how much money you would pay to get there. There's a whole variety of things that go into the conversation and the decision. So interest rates, that's your second piece here, is shopping for a lender isn't just about interest rate. It's about interest rate, cost, and the ability to close your loan. And I say that because this week alone, we have had 3 transactions that blew up from another lender that was involved. It wasn't us, and we're the ones that get the call to say, hey, can you take a peek? Can you save this deal? The sellers have moved out. The buyers have moved here from a different state. They're now living in a hotel. Nobody wants that. And so again, being able to slow down, get that lender all the information up front, understand what's going on, ask great questions. If you're dealing with a lender that isn't open to you asking questions, then you are working with the wrong lender. Because being empowered and having the confidence as you move through this, especially as a first-time home buyer, it's just so important to your ultimate, not only success in getting to the finish line, but how you feel as you move through it. You want to know how it all works. Changing jobs. Okay, this is mistake number 3. This happens more than you think it would. And the job change isn't necessarily the biggest mistake. It's if the job change is in a different line of work, that's a problem. If the job changes your compensation package materially, so for example, let's say that you are receiving a salary at your current employer and you're not receiving any bonus or commission income or overtime income. And then you go to a new employer, same line of work, your salary, let's say, decreases by half. Let's just say that. But now you're earning commission income, bonus income, and you're working overtime. All of those additional income, bonus, commission, overtime, if you don't have a history of earning those, then that is not going to be calculated into your usable income and your debt to income ratio. So I'm sharing this with you because if you went through the pre-qualification process with your previous job, you happen to change jobs, and now you're in that situation, that's going to be problematic from your home loan pre-qualification standpoint. If you're thinking that you might be changing jobs, be sure to talk to your lender before you make the change so you understand as you're negotiating a compensation package or you're entertaining other ideas or other job opportunities, you understand kind of like it's got to be an apples to apples type of approach. I've had this conversation so many times where people have said, but I have the ability to earn more. The ability to earn more isn't what the home lending guidelines are looking for. They're looking for a history of, or they're looking for consistency, meaning a base salary or base number of hours worked with an hourly wage that we can count on. And again, bonus income, commission income, overtime income, those can be used, but only after you've had a history of receiving those types of income. So income is key. Okay, credit. Can we just talk about one of probably the most confusing parts of not just the home loan process, but just how credit and credit scores work in this country? I want to share that there are various different credit scoring models out there. And many home buyers, as they're getting excited and they're looking at their credit score, or your credit card company is sending your score, know that that score isn't the score that the home lender is going to be using as you move through the home loan pre-qualification process. And in my experience, the home lending score seems to be slightly lower, not in all cases, but in many cases, than what we see on our credit card app or if we do credit monitoring ourselves. And that is simply because of the algorithm and the type of credit report that's being pulled. So for the home lending process, when we think about credit, score is important. And so, for example, with a conventional conforming loan, 620 is kind of like that line in the sand to be eligible for a conventional loan. Now, that doesn't mean you're automatically going to be approved. It's not just about credit score. It's about credit profile. So how many trade lines do you have? Do you have any late payments? Are any of those late payments recent or in the last 6 months? All of that goes into the equation for the loan approval. So profile is important, credit score is important, but if you are maybe at a 600 or a 580 credit score, FHA might be a better option. And maybe it isn't, but again, score is just one piece of it, and it's not necessarily the score you're looking at when you're looking up your credit score. It's the score that the mortgage lender is pulling, because mortgage lenders are using a specific type of required credit scoring report, and that's what we're going to use for the home loan pre-qualification. So credit is key. And then, lastly, I'm always asked, hey, so, what's your tip? Here's another big mistake I see with regard to credit, and that is people pay off their credit cards every month, which is great, but there are certain types of people that maybe they travel a lot for their business, they use their personal credit cards, so they're charging up all this debt. And keep in mind that when a lender pulls your credit, it's a point in time. So it's kind of like a photograph. We're going to take a picture of your score. And if you happen to have, let's say, a credit card that's a $30,000 balance, and even though that gets paid off monthly with your reimbursement from your company, if at the time that the lender is pulling your credit and it's maxed out because you had a lot of business travel expenses that month, that scenario right there could negatively impact your credit score. And so again, a lot of this just goes back to that initial conversation. And I cannot stress this enough. This initial conversation, it can be very casual, but let's kind of get into the details and talk with a lender that can help navigate the right questions, answer your questions, but ask questions that they need to know to kind of set you up for the next step in the process. When we think about the home lending process, I'm going to say that initial conversation is absolutely key. And then complete the application, have your credit pulled, provide your documentation, get your pre-approval letter, get out shopping, get under contracts, then the home inspection, then the appraisal, underwriting, getting back the lender any conditions from the underwriting approval, signing all the documents, and then you get your keys. That's kind of like it in a nutshell. Hopefully that helps. If you have any questions or you just want to have a conversation to know if you're in a situation to be able to buy a home or refinance a home, don't hesitate to call or text 480-725-0150.